Hi there. This is the E.M.I. for the month of July. In this month's E.M.I, we ask 5 questions. How has India's services share grown within private consumption? Number 2, what has been the fastest growing segment within private consumption? Number 3, which segment of banks have been the fastest in adopting the RBI's EBLR interest rate benchmark? Number 4, could personal loans be a key beneficiary to RBI rate cuts this time around? And the last, number 5, from when can one expect 12% CAGR returns from investing in gold? Let's jump right in. First question that we're going to ask in this month's E.M.I. is on services share in India's private consumption. This has seen a sharp rise. Services accounts for 55% of India's GDP. However, it is equally important to track the pace of services growth within India's private consumption spending. Post FY20, let's say post-COVID, India's services consumption spending has seen a sharp drop, only to pick up and cross pre-COVID levels in FY24 at 52%. What is even more interesting is that the incremental share of services in total consumption in FY24 stood even higher, well above 80%, and a decadal average share of 65%. Now, why are all these numbers important? Because any additional increase in private consumption spending growth is most likely to land up in a higher share of services. In over a decade, the share of services in private consumption has risen by 5%, spread across segments like transport, services, health, education, etc. Now, breaking down the data in 5-year percentage CAGR buckets, compounded annual growth rate buckets, and anchoring this to FY19 is very important, because if we do this, one sees a shift, a broad shift down in the average pace of services consumption. What does it mean? FY19 to FY24 has seen a lower pace of growth than FY14 to FY19. So FY19 to FY24 saw a CAGR of 5.1% versus 8.6% growth seen during the FY14 to FY19 phase. This was largely in segments like transport, health, education, etc. With nearly 8 clear drivers set for a consumption pickup in India that we covered in our June E.M.I, services segments come increasingly in focus now. Recreation, restaurants, hotels, health, these appear to be the services segments with the highest percentage CAGR during the FY19 to FY24 phase. Now we come to the next segment. We understand in this next segment that durable consumption growth stands out, but with small overall shares. Let us now look at private consumption growth during the FY19 to FY24 period that has grown by 4.8% CAGR, well below the 7.2% growth seen during the FY14 to FY19 phase. While the share of goods in consumption has been trending lower, household appliances, household tools, alcoholic beverages, these segments have seen the highest CAGR in the FY19 to FY24 phase. Within the goods part of private consumption, the fastest growing segment has been durables with 7.7% CAGR during the FY19 to FY24 phase. However, durables as a segment remains under-penetrated with only 4.2% share in private consumption, and this share has grown only by 120 basis points over the last decade. With this framework in mind, the tax cuts and the rate cuts are likely to help turn around urban consumption with a probable services bias. The festive season is just around the corner, warranting markets' attention to how these segments have performed in the recent past. The third segment, we talk about private sector banks and their EBLR loan shares. Private sector banks seem well ahead in terms of their EBLR loan shares. Dialing back a bit, one of the 8 drivers for consumption that we spoke about in our June EMI was that the RBI's rate cuts would have a very different impact this time. Why? This is because the RBI's repo-linked EBLR framework accounts for well above 60% of the scheduled commercial banks' floating rate loan book, greatly improving rate transmission. In other words, the ongoing rate cycle would see EMIs of banks' customers probably move down much faster than it did during the earlier RBI rate cut phases. Again, in our June EMI, we brought out the pace at which the RBI's EBLR system of interest rates became popular all through floating rate loans of banks. From under 3% of EBLR loans in 2019, the share stands at just under 62% as of March 2025, supporting the view that we just laid out earlier about falling EMIs of customers. Breaking down these shares, we notice that the private sector banks have a much larger share of EBLR loans at nearly 87% of their floating rate loan books. Further, RBI survey data also indicates that private banks have increased their shares of EBLR loans at a much faster pace since 2019. With 40% of total scheduled commercial bank loan book with private sector banks, it would be reasonable to expect a large part of this segment readjust their floating rate loans much lower. We now come to the fourth question on private retail loans and their benchmarks. Private retail loans appear much more linked to EBLR benchmarks. In addition to the drivers of consumption we saw in our last June EMI, clubbed with the upcoming season of festivities, it would be very useful to examine the share of EBLR in personal loans. Personal loans as a segment have seen an appreciable pace of growth at 18% CAGR for the FY19 to FY25 period. Within personal loans, durable loans seem to have topped the charts with a high pace of growth at 20% CAGR for the FY19 to 25 period. Moving to the EBLR loan shares within retail loans, we see private banks with much larger shares than public sector banks in housing, in education, even as they barely seem to have a presence in vehicle or auto loans. And lastly, to examine the relevance of private sector market share in these respective spaces, we notice that while private sector banks have a 45% market share in personal loans, they have the highest market share of 72% within consumer durables. We now come to the last question. From when can one expect higher chances of 12% returns on gold investments? Now, take a look at this chart. How do we read this chart? This chart plots the probability of a lump sum investor making more than 12% CAGR over various time frames. Now, conversely, the chart also brings out the probability of making less than 12% CAGR and of negative returns. Now, here are 3 key takeaways from this chart. 8 years is the minimum lump sum time frame from the point of view of capital protection, which means 0% probability of capital loss. Number 2, gold has a realistic return probability for more than 10% CAGR returns as opposed to more than 12% CAGR returns. The last, the probabilities of more than 12% CAGR cross 60% only from the 20th year with a 100% probability at the 25th year. What do the luckiest and unluckiest gold lump sum returns look like? Take a look at this chart. This chart brings out the highest and the lowest lump sum returns for the given time frames of investment. The luckiest 8-year lump sum investor has made 23% CAGR, while the unluckiest 12-year SIP investor has made 2% returns. If a lump sum investor were to redeem his investment in the MCX Gold as of end of 2025 May, he would probably be fairly lucky with more than 12% CAGR most of the time, except for the 12 to 15-year lump sum timeframes. That brings us to the end of our July E.M.I. Till next time, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.